Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. What a day, what a recovery from the lows, and this despite a lot of trade tensions looming over the economy and what's happening with the global uncertainties as well. Of course, today is the expiry day, the final day of this month, so last 1 hour still remains very crucial.
That's right. You encapsulated all the key points, tariffs, expiry day and key results. So markets have a lot of cues that they are taking, and on the back of that we're seeing quite a bit of volatility, but the name of the game is the sharp recovery that we've seen. We have a lot lined up on the show, some key corporate conversations. So let's start off with the top headlines. Sharp recovery on Dalal Street as Nifty and Sensex back in the green, showing resilience to Trump's tariffs. Midcaps to recover but still in the red. FMCG, private banks and media lead sectoral gains, while pharma and realty continue to drag.
Gains Tech surges in trade after a good show in Q1. The company surpasses full-year guidance of 50 basis point margin expansion. Management tells CNBC-TV18 that guidance for this financial year remains intact and they do not see any major impact of tariffs and have factored in the plausible downtick.
Weak Q1 hurts Hitachi Energy as the company reports a miss on revenue, profit and margins, even as order inflows remain healthy.
Indus Towers lower in trade as the company's profit declines and EBITDA comes in below street estimates. Tower additions also come down sequentially.
CAMS is the other stock reacting negatively to its Q1 performance as revenue, EBITDA and net profit miss street estimates, while margins come in slightly above what the street was anticipating.
Okay, all right. Those are the top headlines. But as we've been talking about the big recovery that is taking place, but important flashes for you at the bottom of your screen. Sources on U.S. tariffs, trade discussions in virtual mode are likely to continue. Looks like there will be more decisions on this, and maybe that's what the market is factoring in as well, that this is not the final tariff that has come by. And India is unlikely to jump the gun before knowing any details in a dynamic situation. I think that's what markets are factoring in already, and that is the reason we have seen that sharp uptick from the lows. The Nifty is up 75 points in the green, and it was down 0.7%, but now it's up 0.3%. So basically, it's a 1% gain that we've seen from the lows already. Let's talk about all the mid-cap movers that we have in trade today. Hormuz is joining us as always to take us through that. Hormuz.
Proper expiry session, if you want to say it that way as well, rounding off the month on a high. But yes, the tariff impact is being felt on specific sectors, even if the market has recovered from the lows. So take a look at Pearl Global, take a look at Apar Industries, Vari Energy, most of them at the lows of the day, almost losses of anywhere between 5 to 8%. Take nothing away from earnings, because there are a lot of positive earnings reactions that are coming by in today's trading session. And look at HEG, now 16% higher on that stock. Gains Tech is up 10%, Sagility is up 10%, and Gillette, the numbers came in at one point was up 4.5%, but still holding on to some healthy gains. And some negative earnings reactions as well in today's trading session. A Green Panel is one of them, trying to recover from the low, still 8.5 lower. Sonata Software, we spoke to the management earlier in the day, 5.5 lower, and DCB Bank, a very sharp knock after the numbers were out, 6.5% lower now after the results that were just announced a few minutes earlier. On the volumes front, Greaves Cotton reported results yesterday, but it's making those gains today, 10% higher on that stock. Graphite India is up 6 in tandem with HEG, and Alkyl Amines is at the highs of the day, 4.5% higher on very strong volumes. And lastly, stocks that are at a 52-week high today. Cartrade Tech continues to move higher. Nesco's numbers were out earlier this week. That stock is up 5.5 as well. And Dhanuka Agritech at a 52-week high with gains of around 2.25%. Back to you guys.
Thank you so much, Hormuz, for taking us through all of the stocks that are moving around as far as the broader end of the markets are concerned. Well, a couple of stocks, have a look at a name like Apar Industries. Now, this particular company, makes those conductors as far as the power equipment space is concerned. That particular stock, earlier today had taken quite a bit of a big knockdown, over 6.5%. Which are the stocks that are recovering quite sharply? Some of the capital goods names. Have a look at Cummins India, near the day's highest point. Have a look at Hindustan Bank. That stock has recovered very sharply. The entire PSU banking space has recovered very sharply. Names like SBI, PNB, these are some of the stocks that are doing very well in the session. Some companies that just delivered their results and the reactions to that, have a look at Jubilant Ingravia. That particular stock delivered a set of numbers largely in line to a slight beat. That stock doing quite well. But a very important corporate conversation lined up for you. Tata Steel reported a strong Q1. They beat street expectations. Their EBITDA beat was led by cost transformation and improved European performance. TV Narendran, who's the CEO and MD at Tata Steel, joins us now. Thank you so much, Mr. Narendran, for joining us. Before we go into the results, 25% tariffs have been announced by President Trump on India. What is the impact on the global ferrous industry and for Tata Steel in particular?
Tariffs on Indian exports to the US doesn't have a significant impact on us because, firstly, we are not selling anything from India to the US. The next question is then, does it impact us indirectly because some of our customers may be exporting to the US? Yes, the answer is yes, but it's not such a big component of our volumes. The second part is, this is what he has announced, but as we've seen in the past as well, I think it eventually depends on where it lands at the end of the negotiations with the Indian government. So I think it's too early to draw conclusions. But yes, it's something which concerns India because non-steel exports like pharma and many other industries are dependent on the US market. So I think we should watch that from that perspective.
But it's safe to say there is steel that is exported from Europe to the USA?
That is certainly being impacted by the actions taken by President Trump. In the UK, there is a 10% agreement on the exports. I think the conversation between the UK government and the US is more on the melt and pour conditions because, as you know, we are currently shipping steel from Netherlands and India to UK for converting from slabs into hot rolled coils and downstream products. So that's the only part which we are waiting for clarity. From Europe, while recently there's been an agreement, but on steel, our current understanding, it still stays at 50%, which is very significant. So that's a matter of concern. It has an impact on us, but some of these costs are being passed on to our customers because, unfortunately, for the US customers, they don't have domestic options to source the steel and are dependent on imports. So there is a part of that cost going on to customers in the US, and part of those costs will have to be borne by us. So we're taking some mitigating actions. It's about 10% of our volumes, so it's not that material from a volume point of view, but they're all profitable and high-end products. So it's not easy to develop alternate markets for that either.
Understand, not easy to develop alternate markets. You will be bearing a certain proportion of the cost, but 10% of total European volumes is what you mentioned. So what does that mean in terms of steel in absolute terms?
Yeah, that's right. About 700,000 tons in Netherlands, slightly less than 100,000 in UK. So in UK, it's less than 10%. It's about 10% in Netherlands.
Okay. And what was the benefit of coking coal realized in Q1 FY26? And will there be a similar benefit that we'll see in Q2 as well?
Yeah, I think last quarter we had guided a $10 reduction. We are in that range. $10 to $15 reduction is what we had guided. Both for Europe and India, we are in that range. Next quarter also will, or rather this quarter will also be about $10 lower for coking coal in consumption costs.
Okay, so that is as regards coking coal. Now, in terms of Q2, how are the current steel prices trending when you're comparing it on a sequential basis?
I think the guidance we are giving is that it will be about 2,000 rupees per ton lower in Q2 compared to Q1, for Tata Steel, because some products, move up and down a bit, and on an aggregate basis, we are guiding 2,000 rupees per ton below and lower in Q2 compared to Q1. We had guided 3,000 rupees higher in Q1 compared to Q4. I think we ended up at around 2,600 higher in Q1 compared to Q4. In Europe, it will largely be flat, maybe 5 to 10 euros per ton higher. It won't be going down, maybe slightly higher, but more towards flat.
Okay, and if Europe gets benefit of higher prices and lower coking coal costs, then EBITDA per ton, that can be in the scale of $30 to $40 a ton?
Not really, because there are other costs which are going up in Europe. There are other input costs. So I wouldn't give that guidance. I would say that Netherlands will be in this range, maybe slightly better. UK, we also will be in the range. I wouldn't go say that there would be a big increase in the numbers, the improvement in the numbers, because market conditions are still tight. We're waiting to see the impact of Trump's actions, etc. So, so I think we will say that the guidance on Q2 will be similar to Q1, maybe slightly better.
Q2 slightly better compared to Q1. Also, we are talking about cost transformation savings. How confident are you that you will realize savings of close to 11,500 crore in FY26?
That's right. So this was the targeted saving for this year, and it is backed by very granular level projects which are being undertaken across geographies. We are pretty much on track for most of those projects. There are some areas where we are lagging, but there are some areas we're trying to make up. But we stick with our guidance of 11,500 crores.
Mr. Narendran, what would the difference be between India prices right now, given we do have some safeguard duty and imported costs coming in from China as well?
Difference is narrowed because Indian prices have dropped and domestic prices in China have actually gone up about $30 in the last week or so, right? $30 to $40. So it's not yet attractive to bring in material from overseas. There is some material has come from Russia some time back. So the threat of imports is always there. The other concern is because Indian market is growing, we are able to sell in India, but export prices are not very remunerative. So because the Chinese steel has depressed prices globally. So that's a concern. So it hurts the sentiment. People are always watchful. But it's not as if huge volumes are coming in, but the threat is always there.
Okay, take that point. Now to the balance sheet. Debt is hovering around that 84,000 crore mark. What is the capex plan? What does it mean about the debt reduction plan that you have in FY26?
We are expecting our debt to be lower by the end of this year than where we started. We started at around 82,000 crores. We expect it to be lower. I'm not giving you a specific number, but we'll certainly be lower than that. The capex guidance stays at that 15,000, 16,000 crores that we've guided at the beginning of the year. We are on track for that. We are obviously trying to do what we can to release more from working capital. We've done a good job in Netherlands of releasing a lot of money out of the working capital there. We need to do a similar work in UK and to some extent in India as well. And if our profitability stays at these levels or thereabouts, then we'll be generating the cash flows which will help us bring down the debt.
Thank you so much, Mr. Narendran, for talking to us about Q1, how prices are panning out in Q2, as well as the debt reduction plans going forward. Now we'll slip into a short break, but before we do that, a slight reminder for our viewers: unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our prime members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and master classes, along with curated lifestyle benefits.
Welcome back. Well, you just saw TVS Motor's numbers flashing for you. Sudarshan is joining us now to tell us how did these numbers look. Sudarshan.
So as expected, it's a steady set of earnings from TVS Motor because both TVS Motor and Eicher Motors have been outperforming the peers as far as the volumes are concerned. And that's the reason volumes have helped company report healthy revenue growth. But on the margin front, we'll have to see if the company has included PLI incentives too. Now talking about the headline numbers, profit has increased by almost 35%. It has come at 780 crore. Revenue too has increased by more than 20%. EBITDA has seen a jump of 32%, and margin has come at 12.5% against 11.5%. So here also almost 100 basis points expansion. Good parties realization. It has seen a healthy increase not only on YY but also on a sequential basis. We were expecting there might be an increase of 1% both year on year and QOQ, but here realization has improved 8% year on year, and on a sequential basis it's up 6%. So overall, it's a steady set of earnings from TVS Motor.
Thank you so much, Sudarshan, for joining in. And TVS has been a very, very sharp recovery from the intraday lows post the results that appear to be a beat to our own CNBC TV 18 poll. But before we slip into a short break, it's a good time to remind our viewers to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m. Welcome back to Midcap Radar. Well, we have a very important corporate conversation lined up. Hitachi Energy, that particular stock, has seen a bit of selling pressure after reporting its Q1 results. Now, we are seeing a quarter where the ordering activity was very strong and the order inflow too was quite strong. We are now joined by Mr. N. Venu, who's the MD and CEO at Hitachi Energy India. Thank you so much, Mr. Venu, for joining us. First up, what we want to understand from you is order inflow this time around was very, very strong. Help us break this down in terms of both HVDC as well as non-HVDC orders, and how has the non-HVDC order side of the book grown this time around? And a quick clarification, do you have any exposure to the US market in terms of exports?
So thank you, Vivek, and good afternoon, everybody, and it's a pleasure joining you on your show. So let me take 30 seconds to demystify our whole strong Q1 results, which we have produced yesterday. And as you have seen, our orders are very strong, 365% year on year, and our revenues are also pretty strong, 15% growth on year on year. And we have also have all-time high of order backlog, close to 29,000 crores, and which is also, and since our revenue has grown 15%, and our gross margin is also improved by almost 650 basis points, and which is also culminated into EBITDA margin improvement of close to 700 basis points. And we have also had a very strong, generation of the cash. So all these things is showing us a very strong, momentum to our entire FY 25-26. And coming back to your second question on our thing, our exports, as you know, our exports are generally in the range of 25%. And our exports to the US is very, very low at this point in time. And it is also for us, any additional tariffs, etc., is a cost neutral, it's a pass-through mechanism. So that way, at this point in time, we are not really concerned about the tariffs. But as you know, tariffs is a bigger item, agenda, and we really need to look at it, how it will pan out on an overall basis.
We take that point, and it's an ongoing situation as well. So we'll keep assessing that as and when there are more updates there. Revenue growth at 11%, it's healthy, but maybe the street was expecting more basis the order inflow. Has there been any delay? Do you think that is something that will be accounted for in Q2? And for FY26, what kind of margin number are you looking at?
No, there are no delays, first of all, and as you know that the large projects we have been saying, like HVDC projects, it's a 48-54 month schedule completion, and normally the first year the revenues won't come, and the revenues will start picking up the second year of the ordering out, and that's what we have been saying for HVDC projects which we have booked. So the revenues we can expect in the next financial year, that to the second half of the next financial year, will come in a quite substantial impact. And last year we had a very good growth. On the overall basis, we had a 24% growth. On top of that, we are growing 15%. I think it's a very good growth in my view. Without considering the large orders.
Understood that. Mr. Venu, one thing that the street wants to know is that I believe you've actually told the analyst community that you're anticipating close to 2 large HVDC orders every year. How is the order prospect pipeline looking at? Have you placed bid in all of the recent ordering or the tendering that has happened? And probable size of the order that you're expecting in FY26 and FY27?
So what I have told the analyst community is that, to manage the complexity of energy ecosystem in India with so much of renewable coming in, country needs to have, many HVDC projects. And we see the pipeline of 2 HVDC projects coming into the market for bidding every year from now to at least next 3 to 4 years. This is what we are saying. It comes from the market. It's not that we're going to get it. We will be bidding all the projects. We will be bidding every project. We look at every project how it will fit into our delivery schedule, our manufacturing schedule, our risk reward. All those parameters will be looked into it, and we will be bidding for those projects. And we are also, as you know, we are also expanding our manufacturing in anticipation of not only the HVDC, but also other demands in the country. We are, as you know, we have announced our 2,000 crores capex, which we have been, spending in all our portfolio expansions, both brownfield expansion as well as greenfield expansion.
Mr. Venu, last question before we let you go. What's the margin differential between HVDC and non-HVDC orders? That's something that everyone's been eyeing out for.
No, margin difference, every project we are looking at, and it is in line with our margin aspirations. So we don't.
That's around 10.5%?
So we don't want to say, as I said, we are improving it, and I made it in your own show last year that we entered into double digit. We entered much ahead of the curve, and we are improving further. And this year also, we will do better than last year.
Okay, thank you so much, Mr. Venu. A very short conversation this time around, but we hope to get you soon to discuss more, especially as far as the ordering prospects are concerned for your company for the remainder of FY26. Thank you once again. But with that, it's all the time we have on this edition of Midcap Radar. The market recovery continues. Your stocks when we return.